Good morning, students. Welcome you all once again. And today we are going to discuss Ind AS 37, which is a standard which talks about provisions, contingent liability, and contingent assets. Right. So, students, why this standard is important, or is it a new standard, or have we read these concepts in our earlier gap or in our earlier accounting standards? Yes, we have already understood and we have already read these concepts in our earlier accounting standard, which is AS 29. So students, in IGAP scenario, in Indian gap scenario, our last standard and our old standard is AS 29, which takes care of provisions, contingent liability, and contingent assets. AS 29 is there, okay, which we have already aware of. AS 29. If I talk about global scenario, Ind AS 37 is outcome of IAS 37. Students who have also opted for GFRS paper. So globally, it is International Accounting Standard 37. In IFRS, it is IAS 37, and Ind AS 37 is the converged version of IAS 37. So these are the three standard which is available as on today. Ind AS 37, which is the curriculum of CA final FR paper. IAS 37, which is a IFRS standard, which 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 is a global standard and which is the curriculum of GFRS paper. And AS 29, which we have already read in our CA intermediate or IPCC. Right? Right, student? Good. Good morning, Rashmi. Good morning, Rahul. Yeah. Students, first of all, why this standard is important? Have you seen the balance sheet? Any balance sheet? Since you are a CA final student, you must have prepared some balance sheet. You must have audited some balance sheet. You must have seen some balance sheet. So why this standard was required? Why this standard is required? Students, when you look at the balance sheet, in balance sheet, every item is not actual. Some items are estimates also, right? For example, fixed asset. Fixed assets are actual. The company which have acquired fixed asset, so it has to be recognized fixed asset and it has to show those fixed asset in the balance sheet. Intangible asset, it is not an estimate, it is again actual, right? But there are some provisions which is there in the balance sheet. Provision for employee benefit, provision for gratuity, provision for leave encashment. What is these provisions? So these provisions are the estimate, right? Like you are getting the actuarial valuation done for gratuity, leave encashment, or other employee related provisions, long term provisions, right? So these are the estimate. These are not actual number. These are the estimated numbers. Provision for warranty obligation. In many of electronic companies' balance sheet like Samsung, LG, right, Sony, JBL, you must have seen the provision for warranty obligations, right? What is this provision for warranty obligation? These numbers are not actual number. These are the estimated numbers, right? Provision for doubtful debt. What is that? Again, it is an estimation. It is not something which has already converted into bad debt. It is again an estimation. Provision for asset retirement obligation. If you will look at the Aman offshore balance sheet, Reliance Industries balance sheet, Indus Tower balance sheet, Bharti Airtel balance sheet, you will find a provision for asset retirement obligation, right? Again, it is an estimated number. So in balance sheet, a lot of numbers are estimated number, right? And when I talk about actual is an actual, right? If a company has recognized some asset, okay, you will ask for the invoice, you will ask for the actual proof of the actual artifact, actual proof, actual evidence of those costs incurred for purchase of those assets, right? But if I talk about some best estimate, if I talk about the provision, if I talk about estimate, it involves management judgment also, right? So why this standard is there? This standard is there to facilitate, to provide authoritative guidance where the estimates are required, right? Where the provisions are required, okay? And why it is important? I'll explain this with the help of this example. For example, there is a company, and the company is, let's say, a listed company, right? So being a listed company, they are publishing their quarterly results. So Q1 is there, Q1, Q2, Q3, Q4, right? These are the 4 quarters. And in the 4 quarter, let's say the profit of Q1 is, let's say, 120, right? The profit of Q2 is, let's say, 100. The profit of Q3 is, let's say, 90. And the profit of Q4 is, let's say, 70. These are the profits of the company. If you will look at the profits of the company on a quarter-on-quarter basis, these are the declining profits, right? The trend is declining. But the company wants to show the growth trajectory. The company wants to show the growth trend, increasing trend of these profits, right? So what the company has done, the company has created some provision, right? The company has created some provision for expenses, right? Because provision is an estimate. So in the first quarter, the company has created a provision of, let's say, 70 crores. So 120 minus 70, what is the number? 50 crore is the number. In the second quarter, the company has created a provision of, let's say, 30 crores. So what is the number? 100 minus 30 crores? 70 crore, right? So the total provision created till Q1 and Q2, it comes out at 70 plus 30, 100 crores. Total provision of 100 crores has been created in Q1 and Q2, right? When the company came to Q3, so now, since the profit is only 90 crores and the company wants to increase the profit, so from 70, so what the company has done, the company has released, so here 70 negative, 30 negative. Now out of this 100, the company has released 20 crores, right? So now this profit become 110 crore. From 70, it shoots up to 110 crore. And since in Q4, the company has said that this provision is not required, right? This provision is not required. And the entire 80 crore, the company has reversed in Q4. So now this profit become 150 crore. Guys, if you see, the provision which was created in Q1 and Q2, it got reversed in Q3 and Q4, the entire provision, right? And without provision, if you will look at the number of profit, it is declining trend. The profit is declining trend. But after creating provision and after reversing provision, it means managing the provision and manipulating the provision, the trend is increasing trend. The trend is increasing trend. So dear friend, you can see that the beauty of this provision is the declining trend has been converted into the increasing trend and the number remain constant. There is no change in the number. If I look at the total year profit, earlier it was 120 plus 100, 220, 220 plus 90, 310, and 310 plus 70, 380. If you will add 50 plus 70, 120, 120 and 110, 120, 220, 230, and 150, 380. This 380 is 380, but the growth story, the trend has completely been changed. And that is why, since the company has started manipulating their profits due to the provisions, and that is why a need was felt to include some authoritative guidance, and hence this AS 29 or IAS 37 or Ind AS 37 was introduced. Ind AS 37 takes care of that when a provision is going to be recognized, when, right? At what value the provision is going to be recognized, it is a best estimate, okay? And what is the subsequent measurement of the provision, right? So these all answer has been given by Ind AS 37, and that is why Ind AS 37 plays a very important role in creation, in measurement, or in recognition of a provision for expenses, right? Is it clear? Whenever I'm talking about the word provision, it is more from the liability and expense point of view. Provision is not an asset, right guys? I hope it is clear to all of you, right? These are the virtual sessions. Can you please respond on the ICAI query link, right? Good. Thanks, Koshiki. Thanks, Rashmi. Okay, let's move on. So we have understood why this provision standard is required, because it is an important tool to manage the profits as well, right? And hence the need was there to create a authoritative guidance. And from that perspective, this provision is there. Coming to the agenda of the standard, objective and scope, right? Like every standard, we will be talking about what is the objective of the standard, what is the scope of the standard, right? So why this standard? Objective means, scope means where this standard, as simple as that. Then we will be talking about some important definitions, right? And when I'm talking about definitions, 4 definitions are important in this standard. One is liability, because this is a liability based standard largely. One is liability. Second, within liability, what is meant by provision, right? So we will be discussing about the definition of liability, provisions, then contingent liability, and then contingent asset. So 4 definition, 4 meaning we will understand in this particular standard. Then we will be discussing about recognition and measurement. So friends, the title of the standard is provisions, contingent liability, and contingent asset, right? The first one is provision. So if I'm talking about recognition and measurement both, if I'm talking about recognition first, provisions are going to be recognized, right? Provision is something which is going to be recognized. Whether contingent liability and contingent asset is going to be recognized, yeah? Whether contingent liability and contingent asset is going to be recognized, contingent asset, contingent liability. As the word is contingent, it is an off balance sheet item. Contingent asset and contingent liability does not require any recognition. The moment when the contingent liability and contingent asset will get recognized, it become the liability and it become the asset, right? So contingent asset and contingent liability is a off balance sheet item. It will go into the notes to accounts. Absolutely correct, Sumit, Rashmi, and Koshiki, absolutely right. Yeah. So as far as recognition is concerned, we are only talking about the word provision. Provisions are going to be recognized. Contingent liability, contingent asset are not going to be recognized. But as far as measurement is concerned, please tell me whether this measurement word is only applicable to provision or it is applicable to contingent asset and contingent liability as well. Guys, tell me, as far as measurement is concerned, whether this measurement, recognition we understood, right? But as far as measurement is concerned, whether this measurement word is only applicable to provision or it is also applicable to contingent asset and contingent liability. Yes, Rahul. Yes, Koshiki. You're right. You're right, Smith and Rashmi as well. The word measurement is applicable to all these 3 items, right? Measurement is applicable to all these 3 items, right? Because if you have to disclose contingent asset and contingent liability, even though these contingent asset and contingent liabilities are going to be measured, right? If you will measure, then only you will be able to quantify and you will be able to disclose, right? So measurement is there, but the recognition is not there for CL and CA, right? Contingent liability and contingent asset. We will be discussing about recognition and measurement, but we understood that contingent liability, contingent asset is not going to be recognized. It is an off balance sheet item and it is going to be into the disclosure. Reimbursement. We will be talking about reimbursement if we are creating a provision and someone is giving us some reimbursement, then what is the treatment of that reimbursement? For example, we are creating a provision for warranty. For example, I'm a dealer and I am a dealer, I am giving a warranty. I am giving a warranty to my customer, and this warranty is coming from the manufacturer, right? So if tomorrow there will be any fault, customer will come to me. Customer will not go to the manufacturer, na? He will come to me, and he will come to me, and I have to get the damage repair. I have to incur this cost, but I am entitled to get this cost reimbursed from the manufacturer, right? So the moment I'm spending some money, the moment I'm creating a provision or spending some money, of course, I am entitled to get this money recovered from my manufacturer. So means that is a reimbursement. So this standard also specify that if in case of a reimbursement, what should be the accounting treatment, right? Changes in provisions being a best estimate, right? As I told you, provision are not the actual numbers. These are the best estimate. Okay. So if something which is an estimate, of course, it will keep on changing. It will keep on increasing or decreasing, right? So it will keep on actualizing on the basis of the development of the facts and circumstances. So if there is a change in provision, how this change has to be accounted for, the guidance is given under this particular standard. Then under this standard, we will be talking about some specific guidance. For example, if the provision are long term, for example, today you are creating a provision, you have to create a provision, but the settlement will happen after 5 years. Like there was a court case which was going on, right? And the company has lost that court case, right? And the court has announced a judgment, or the court has announced a decree that this company has to pay 20 lakh rupees, right? This company has to pay 20 lakh rupees. Now the company has pleaded that, my lord, I don't have this money right now, please allow me 3 years time or 2 years time, and after 2 or 3 years I'll pay 20 lakh rupees. The court has also agreed, and the court has said that you have to pay 20 lakh rupees compensation after 2 years. Now the court has already announced its verdict, right? But the payment or settlement has to happen after 2 years. But since the court has already announced the verdict, and we are aware that we have to pay 20 lakh rupees, right? But not today, after 2 years. So this provision is required to be recognized. But at what value? At what value? So standard says that if it is long term in nature, you have to create at a present value. Means time value of money is important, and provisions are required to be discounted. So friends, these kind of guidance we will be discussing about in this particular standard. Like future losses, the standard also talks about the future losses. In case of future losses, whether the provision has to be taken right away or the provision has to be taken at a later stage. So we will be discussing about these kind of guidance as well. And the last, the disclosures are there, and you are aware that the disclosure are the essential and integral part of the standard. So then disclosures are there. Clear? Is it clear or not clear? So we are only talking about the agenda, right? Okay, what we are going to cover in this standard, right, guys? As far as structure is concerned, we will be covering this standard in the 2 classes, today's class and Tuesday, in the class which will be happening on Tuesday. So we'll be covering in this 2 part, right? This is a middle level standard, I would say. This is not a small standard, not a big standard, right? Average standard. Third, this standard is very important from examination perspective as well as real life perspective, right? Coming to the objective, friends, Ind AS 37 ensures that appropriate recognition criteria and measurement basis are applied to provisions, contingent liability, and contingent asset, right? Appropriate recognition criteria. Why the word appropriate recognition criteria is used? Why appropriate is used? You have not seen this appropriate word in other standard where recognition criteria was there. In PPE, you have not seen the word appropriate, right? So when you read the objective of PPE standard, it talks about that this standard talks about the recognition of PP, but it never said the appropriate recognition of PP. But why the word appropriate is there? Because there may be ambiguity in creation of provision, because it is something which is an estimate, right? Which is an estimate. For example, provision for leave encashment, provision for gratuity. So guys, provision for gratuity, you are creating a provision for gratuity on the basis of future, right? So you are creating, why you are creating? Because your employee are rendering services, and every year the cost has to be incurred. Every year the cost has to be there. But tomorrow, let's say the rule is the gratuity will be payable to only those employees who will complete 5 years in the organization. An employee who has completed 1 year, 2 year, let's say less than 5 years, there is no certainty that he will complete 5 years, right? But we are creating provision on the basis of some estimate. For example, what is the attrition rate? What is the escalation rate? What is the retirement age? What is the mortality rate? So actuary is taking care of all these assumptions, and then he is calculating a liability for gratuity, provision for gratuity, right? So since these require a lot of judgment and estimate, and that is why the word appropriate recognition criteria is used, right? Not like that recognition criteria, what we have seen in one of the example where the company in the first 2 quarters was creating a provision for expense, and in the last 2 quarters reversing that provision for expense, right? So that is why the word appropriate has been used. If you read the standards are very beautifully drafted, I would say, right? Every word has some meaning, I would say. Okay. So friends, this standard talks about recognition criteria and measurement basis applicable to provision, contingent liability, and contingent asset, right? Sufficient, and this standard also talks about that you need to provide sufficient information in the notes to accounts to understand the nature, timing, and amount, right? For example, if there are contingent liability, so sufficient disclosure should be there so that user will be understand what is the nature of the contingent liability. Is it related to direct tax? Is it related to indirect tax? Is it related to some court matters? So user should be able to understand, and user should be able to understand the amount. Of course, amount will be there, the nature, and what will be the timing, right? So timing means if tomorrow, let's say there was a court case which is going on, right? So the timing should be there, that when this liability may be converted, when this contingent liability may be converted into liability. So these sort of information should be there in your notes to accounts, right? So this was a simple objective theoretical concept, not much relevant from the examination perspective. Coming to the scope part, like you have told us in just a couple of minutes back, you have taken an example of provision for leave encashment, provision for gratuity. So whether this standard is applicable on provision for leave encashment and provision for gratuity. So friends, this gratuity and leave encashment is also a provision, right? Is also a provision, but it is not covered in Ind AS 37. Where it is covered? The provision for leave encashment and provision for gratuity is covered in Ind AS 19, employee benefit. These are the employee related provision. It is not covered in 37. It is covered in 19. So friends, you must have seen in so many standards that the standard is covering a lot of items, but the exceptions are there. What are the exceptions? The exceptions are there for those items which is covered in the relevant standard. Like we have read Ind AS 36 impairment of assets, right? So if you will see the scope part of impairment of asset, it says that this standard covers all the impairment on asset except provision for doubtful debt. Except provision for doubtful debt. Why? Because the provision for doubtful debt on the debtors or trade receivables has been taken care under expected credit loss model under financial instruments Ind AS 109. Okay. It says that the impairment of asset is not applicable on inventory. Why? Because it is already covered in Ind AS 2 inventory standard. Right? Likewise, provision for gratuity, provision for leave encashment is not covered in Ind AS 37. Where it is covered? It is covered in Ind AS. It is covered in Ind AS 19, employee benefit. Likewise, provision for doubtful debt. It is not covered in Ind AS 37. Where it is covered? It is covered in Ind AS 109 because the debt is a financial asset. Okay, it is covered in Ind AS 109. Provision for current tax, provision for income tax, provision for deferred tax. Again, it is a provision, but this provision is not covered under Ind AS 37. This is covered under Ind AS 12, income taxes, right? The provision for lease, right? Lease liability. You have to create a lease liability. Okay, you have to create some lease related provisions. If some lease related provisions are there, it is covered under Ind AS 116. It is not covered under Ind AS 37, right? We are talking about the exception part. We are talking about the exceptions. Okay, right, guys? I hope it is clear to all of you. Good morning, Viraj. Good morning, Pooja. Right, since under Ind AS 115 revenue from contract with the customers, if the company is creating some provision relating to the revenue, or the company is reversing the revenue, right? In that cases, it is dealt in by Ind AS 115. It is not dealt in according to Ind AS 37, right? Have you guys completed Ind AS 103 business combination? I believe you guys have completed business combination and consolidation. So in business combination, you have read, you have gone through a word, contingent consideration. Contingent consideration means the acquirer may pay some consideration depending upon happening of some future event. So this contingent consideration of an acquirer is not covered under Ind AS 37. It is covered under Ind AS 103, right? So technically, if there is a relevant standard on these items, in that case, Ind AS 37 is not applicable. Okay, Ind AS 37 is a general standard. Ind AS 37 is a general standard. It will be applicable on all the provisions for expenses on the liability side if a specific standard will not be there for those provisions. Sir, what could be those provisions? Provision for expenses could be. Provision for legal claims, right? For example, a court case is going on and you have to estimate what should be my provision for expenses, provision for legal claims, right? Provision for warranty obligation. For example, Samsung is selling 50,000 unit of mobile phone every year, let's say. And out of those 50,000 mobile phones, they are giving the warranty of 1 year. Let's say 1 year warranty is there with every mobile phone. So Samsung is also estimating and creating a provision for warranty that if I am selling 50,000 units, probably 4,000 or 5,000 unit will come for repair or replacement under the warranty period, right? And now this for this provision for warranty, there is no specific standard. So this provision for warranty is covered under Ind AS 37. Second example, provision for asset retirement obligation, provision for dismantling obligation, provision for site retirement obligation. For these kind of provisions, what is applicable? Ind AS 37 is applicable. Right, friends? Is it clear? Good. Now, this part we have understood because a specific standard is there, and that is why Ind AS 37 is not applicable. But what about this part? Executory contract. This standard is not applicable to executory contracts. What is meant by executory contract? Executory contract means, please write down, executory contract means those contract where neither party has performed their obligation or both the parties have equally performed their obligation. Where neither parties have performed their obligation or both the parties have performed their equal obligation. For example, I am a chartered accountant and let's say I am providing my services to X Limited for let's say filing of GST returns. And there are 4 GST return which has to be filed on a quarterly basis: Q1, Q2, Q3, Q4. So now friends, I have agreed with the I have entered into a contract with the company or agreed with the company that I'll file 4 GST return, and every quarter you have to pay me 10,000 rupees for one GST return. So for Q1 I have filed the return, and for Q1 the company has also created a provision for expense, right, for 10,000 rupees, or the company has paid 10,000 rupees. For Q2 neither I have filed my return nor the company has paid me, right? So in the first case, the I have performed my obligation and the company has also paid me, right? In the first case, so both the parties have performed their equal obligation, or neither of the parties have performed their obligation. In the second quarter, neither the company has paid me nor I have provided my service. So executory contracts means both the parties have equally performed or both the parties have not performed, right? So this standard is not applicable to the executory contract, right? But if the executory contract are onerous, so this standard is applicable to onerous executory contract. What is meant by onerous? Onerous means loss making. If the executory contract are loss making, in that case the provision has to be taken for those loss making executory contract. For example, I am a company and I have entered into a contract with the customer to supply the goods or at a particular delivery date, right? If I'll not supply the goods to the customer will not pay me, right? So it's an executory contract. If I will supply the goods to the customer will pay me. So either both the party will perform their obligation or neither of the party will perform their obligation, right? Or equally perform their obligation. But there is a clause which says that if I will not deliver on a particular delivery date, I am obliged to pay to my customer a penalty of 50,000 rupees. I have to compensate my customer with a penalty of 50,000 rupees, right? So friends, let's say the product which I am supposed to deliver to my customer was worth rupees 5 lakh, right? But till the time I have to deliver that product to the customer, the raw material prices has gone up blindly, right? And now the cost of the product, now my cost of the product which is there is coming out at 6 lakh rupees, and the customer will not give me any compensation for that, right? Because there was a contract, and the customer will pay me 5 lakh rupees only if I have to deliver those goods. If I'll not deliver those goods, I have to pay him 50,000 rupees. So guys, if I will deliver the goods to my customer, I will have to incur a loss of 1 lakh rupees. If I'll not deliver the goods to my customer, I have to pay a penalty of 50,000 rupees. According to you, what is the best case scenario? According to you, what is favorable for me as a company? Delivering the goods or not delivering the goods? With assuming price escalation clause is not there. You're right, Koshiki. Penalty means I'll not deliver the goods. So friends, on the delivery date, neither I have performed my obligation nor the customer is performing his obligation. Do I need to create any provision in this case? Do I need to create a provision? Yes, I have to create a provision of penalty for 50,000 rupees, right? Although I have not paid the penalty, I have not paid right now, right? But as per contract, I have to create a provision in my books of accounts, right? Probably tomorrow, I will be able to negotiate with my customer, and probably tomorrow, I will not require to pay any penalty. But since as per contract, it will become an onerous contract. Onerous means loss making contract for me. And hence I have to create a provision of 50,000 rupees. Sumit is asking, sir, if price escalation clause is there, Sumit, in that case, it will become the executory contract, right? It will become the executory contract because the customer will pay me 6 lakh rupees. Then why should I not deliver, right? I will deliver and I'll get the money. Okay. So in that case, but it will become an onerous contract, a loss making contract if I'm not delivering that product, right? So the point is, I want you guys to let you understand that on executory contract, this standard is not applicable. But if the executory contract is loss making from that company perspective, then it will become the onerous executory contract and standard is applicable on this, right? Like I have to create a provision of 50,000 rupees, right, guys? Is it clear? Okay. For example, company will say that, no, I don't have to pay this amount. I should not create a provision. But as an auditor, you have to say that, boss, this has become your onerous executory contract, onerous contract, and you have to create a provision. So we will be discussing the concept of onerous provision, onerous contract in detail. Okay. Don't worry about that. Right. Friends, quickly tell me whether these are the provisions which is covered under Ind AS 37 or some other standard. Provision for depreciation and amortization. Is it a case of Ind AS 37 or other standard? You are also creating a provision for depreciation, na? Again, it is an estimate. Yeah. Please tell me. Yes, you are right, Rahul. So this provision for depreciation and amortization is covered under Ind AS 16 and 38. Provision for legal claims. Provision for legal claims. Yes, it is covered under Ind AS 37. It is covered under Ind AS 37, right? Provision for doubtful debt. It is covered under Ind AS 109, right? Because it is on the financial asset. So it is covered under Ind AS 109. Provision for income taxes. Provision for income taxes. It is covered under Ind AS 12, income taxes. Provision for product warranties or refunds. Product warranties. Provision for warranties. It is covered under Ind AS 37. Ind AS 37. Amount payable for utilities. It is covered under Ind AS 37. This is provision for expenses, right? Ind AS 37. Right, guys? Any doubt in any of these examples? Any doubt in any of these examples? Are you guys able to understand so far? Are we on the right track? Are you enjoying the session? Please let me know. Good. Let's move on. Friends, tell me whether provision is a liability or liability is a provision. Tell me, what is the right word? What is the right sentence? Whether provision is a liability or liability is a provision. What is the right sentence? Provision is a liability. Yes, Sumit. Utility means electricity, water, right? Or other facilities. Provision is a liability or liability is a provision? Yes, provision is a liability. Liability is a bigger word. Friends, now the liability could be of three types. Liability could be of three types. Trade payable. Have you heard about trade payable? Creditors, trade payable. Or we can say that sundry creditor also. Accrued expenses. Have you heard about this word, accrued expenses? Provision. Provision. Right? So, provision, accrued expenses, and trade payable. What is the difference between these three items? Provision, accrued expenses, and trade payable. Right? What is the difference between these three items? Kochiki has explained very well. He has told, sir, liability is one side of balance sheet, consists of provision also. So basically, she has proved that, sir, liability includes provision, and why? This is the reason. Very good, Koshiki. Right? And everyone has given a right answer that provision is a liability. Okay. Viraj is saying, sir, provision is unpaid. You're right, Viraj. And what is meant by trade payable, and how is it different from accrued expenses or provision? Friends, trade payable means the payable on the basis of invoices. For example, I have provided my services. I am a chartered accountant and I have agreed with the company that I'll file 4 GST returns and you will pay me 10,000 rupees every quarter. The moment I am delivering my services, or let's say I am providing a retainership service to my client on a retainership basis. So after completion of 1 month, the company is creating the company is recognizing an expense, but I have not raised the invoice and the company has not paid me. So in that case, whether it will be a trade payable or accrued expenses, this accrued expenses could be accrued and due, and accrued but not due. Both can be possible. So friends, in this case, this will be an accrued expenses, right? This will be an accrued expenses or outstanding expenses. But the moment I'm raising an invoice, it will become your trade payable, right? So what is meant by trade payable? Trade payable means payable on the basis of invoices for goods and services. So trade payable means payable where invoices for goods and services have been received. Invoices for goods and services have been received. Trade payable means payable where invoices for goods and services have been received. Is it clear? Clear, guys? Invoices for goods and services have been received. So there is a thin line difference between accrued expense and trade payable. Have you understood? The moment I have provided my service, the company has to accrue the expense. But at the end of the month, if I'm raising an invoice, it will become trade payable. If I'm not raising an invoice, the liability become accrued expense. As simple as that, right? And accrued expense means accrued but due, accrued but not due. So in my case, it become accrued and due. Second example could be rent. For example, the rent cycle is 15 to 15, right? On the 15th of every month, the rent become due and the company has to pay a rent. And I'm assuming it is not an advance rent, it is a rent on accrual basis. So friends, when the company is closing books on 31st March, when the company is closing books on 31st March, whether that 15 days rent has to be taken care or not, whether the 15 days rent has to be taken into consideration or not. Yes, we have to recognize an expense for 15 days rent, but the cycle is 15 to 15. So this is something which is accrued but not due, right? So, but accrued expenses has to be taken. Accrued expenses means outstanding salary or outstanding rent, right? Or outstanding professional fees. Outstanding professional fees matlab means accrued, right? Accrued for which invoices has not been received. The moment invoices have been received, it will become your trade payable. So there is a thin line difference between accrued expenses and trade payable, right, guys? outstanding electricity expense, outstanding other expenses. Okay. Friends, tell me one thing, audit fee. Whether audit fee is a provision or accrued expenses. You all are doing your articleship and you must have heard this word कि audit fee का provision कर लेना. So audit fee का provision कर लेना, whether that audit fee is a provision or accrued expenses. Because invoice तो आता नहीं, the auditor will not raise the invoice na till the time he will not complete the audit, and the auditor will complete the audit for 31st March, and for 31st March he will not come for the audit on 31st March because he will come after 31st March. But the client has to recognize the audit fee expense in the books of accounts on 31st March. So whether it will be a provision or it will be an accrued expenses, audit fee. Smith is saying provision, Koshiki is saying accrued expenses. Viraj, what is your view? Rashmi, what is your view? Pooja, Manoj, what is your view? Salendra is saying provision. Guys, now let me give you the definition of provision. Provision is a liability of uncertain timing or amount. Provision is a liability of uncertain timing or amount. So guys, whether this audit fee is uncertain in terms of timing or amount, it is already approved in the board audit committee. So this is something which is already agreed, contractual. Whether the timing is uncertain, it is also clear that audit fee has to be payable for this year, right? So that is why you are creating an expense in your books of accounts now, because you know that whatever results, whatever financial statement I'm preparing for, let's say FY 21-22, the audit has to happen and the result has to be published, or result has to be filed with the MCA. So if the audit will not happen, the result will not be able to file with MCA. So we are aware that this audit fee is related to FY 21-22. We are aware that this audit fee amounting to rupees 10 lakh. So what is uncertain? Neither timing is uncertain nor amount is uncertain, right? Friends, audit fee is not a provision. Audit fee is an accrued expenses. You cannot say that the timing or amount is uncertain for audit fee. It is not uncertain, it is certain, right? It is certain. And audit fee is not something which is also on the basis of percentage of turnover. It is not like that. If my turnover will be 200 crores, I'll give you 0.5% of the audit fee, right? So it is also not allowed. Otherwise, auditor will always push about creating an artificial revenue also, right? So audit fee is not a provision. Audit fee is an accrued expenses. We normally in our layman language use the word provision, but it does not mean it is actually a provision. Have you understood this thing? So provision is a liability of uncertain timing or amount, but accrued expenses and trade payable, it is a liability where the timing or amount is certain, right? Clear? So don't relate the timing or amount with settlement. You will say that, sir, I know the client, he will not pay the audit fee. I know the client. So guys, that is something which is different. I am not asking that whether the client intention is not pay, it does not mean you have to not recognize the liability. So the intent to settle is a different thing. I am talking about whether the incidence or occurrence or incurrence of audit fee, is it something which is uncertain relating to amount? Answer is no. Is it something which is related to uncertain about the period? Answer is no, right? Okay. So Viraj, accrued expenses is not part of provision. Accrued expenses is part of trade payable, right? Provision are separate. Sumit is asking if it is a compliance fee. Sumit, compliance fee is also accrued expenses. Okay. Kosiki is asking, sir, why balance sheet में provision for audit fee लिखते हैं? Kosiki, that is wrong. That is not right. Okay. Normally, as I told you, that in a very layman language, we are using this word very loosely. Provision. Telephone expense का provision कर दो. Right. Audit fee का provision कर दो. Right. Clear? You are aware कि rent देना है. Rent का provision कर दो. Okay. So, but these are the accrued expenses. Provision means liability of uncertain timing or amount. Sir, what could be the definition of provision? What could be the example of provision? Gratuity. Gratuity. Provision for gratuity. Provision for leave encashment. Provision for doubtful debt. Provision for asset retirement obligation. Provision for warranty. Provision for legal claims. These are the example of provision. But friends, these two provision, of course, these are provision, right? And that is why it has to be shown separately in the balance sheet, right? Provision for doubtful debt, it has to be shown separately in the balance sheet, right? Provision for asset retirement obligation, it has to be shown separately in the balance sheet. It is not merged with the trade payable or accrued expenses. Warranty, legal claim, this has to be shown separately in the balance sheet. Let me show you one of the balance sheet, right? Please let me know if my one of the annual report is visible. Please let me know. Give me a minute. I am opening one of the balance sheet. Just give me a moment. Please let me know if my Indus Tower annual report is visible. Yes, it is visible. So let me show you the financials. This is the balance sheet. You can see in the balance sheet. I'll show you. These provisions are separate. In the balance sheet, I'll show you these provisions are the separate. These provisions are separate. Right. Go on the liability side. You can see this provision word 18, right? This is the long-term provision and this is the short-term provision. Okay. 18. Okay. Now let's go to the note number 18. Let's look at the note number 18. Provisions. Asset retirement obligation. This is covered under Ind AS 37. Gratuity and long-term service award. This is covered under Ind AS 19. This is employee related provision, right? Ind AS 19. Right. Then current provision, gratuity, leave encashment. This is Ind AS 19. So this provision has been shown separately, right? This has been shown separately. Clear? And there will not be any accrued expenses. It has been merged with the trade payable, right? As required by Schedule 3 also. Is it clear? Is it clear, friends? I hope it is clear to all of you. Yeah. Is it clear to all of you guys? You can see that audit fee. You can see that the word provision for audit fee has not been used. The word only audit fee have been used, right? Clear? And I'll show you the provision for doubtful debt has also been shown separately. although it is required to be netted off with the trade receivable, but it has been shown separately in the disclosure of trade receivable. I'll show you that part also. Yes, trade receivable. Allowance for doubtful receivables. This is provision for doubtful debt. It is as per Ind AS 109. So this is also disclosed separately. Is it clear, friends? Is it clear? As I told you, that accrued expenses are also kind of trade payable as per Ind AS schedule, as per Schedule 3, right? As per Schedule 3, because these are also liability. The services has already been performed. It is the amount is certain, the timing is certain, and that is why it has been clubbed under trade payable only. Okay, is it clear? This is requirement of Ind AS Schedule 3, right, guys? Shall I move forward? Asset retirement obligation covered Ind AS 37. Yes, Sailendra, it is covered under Ind AS 37. All the provisions are covered under Ind AS 37 where the specific standard is missing, right? Is it clear? So guys, just give me 1 minute. Okay. So let me go back to my PPT again. So we have discussed provisions, accrued expenses and trade payable, right? Now let's discuss about the liabilities and provisions. Friends, first discuss about the liability. What is meant by liability? So liability is a present obligation arising from past events, the settlement of which is expected to result in an outflow of resources embodying economic benefit. What is a liability? The three constituents, or I would say three component of liability is there. Present obligation, arising out of past events, which is resulting in outflow of resources, means cash settlement. Resources. So guys, let's say I'm a company. I have taken a goods and services, or I have taken a services from my chartered accountant, right? I'm a company and I've taken a services from Viraj, who is a chartered accountant. So please tell me, if I have taken a services from Viraj, is it a liability? I have already taken a service from Viraj. Is it a liability? So let's evaluate whether it is a liability. Is there any present obligation due to the past event? If yes, what is the past event? What is the past event? The past event is I have entered into a contract with Viraj and I have taken a services from Viraj, right? Is there any present obligation? Yes, since due to the past event, I have entered into a contract, I have taken a service, there is a present obligation to pay Viraj, right? Whether this will result in outflow of resources, whether this will result in cash settlement. Yes, this is resulting in cash settlement also. Since I have taken a services, I am obliged to pay him, and that is why the outflow resources is also certain, right? Doesn't matter whether I'll pay him or not. That is my bad intent. But accounting only not goes by the bad or good intent. The accounting also goes by the incidents. Due to the past event, I have a present obligation to pay, and whenever I'll pay, it will resulting in outflow of resources. Why the word resources has been used? Probably I'll not pay cash to Viraj. Probably I will give some assets to Viraj. Probably I will give my goods to Viraj. For example, I am a textile manufacturer, and instead of paying him money, Viraj says that Alok, I need some, I need this garments, right? So I have supplied him garments. Okay. So that is why the word resources has been used. So liability is a present obligation arising out of past event, which is resulting in outflow of resources, right? Audit fee, whether audit fee is a liability, I mean to say payable. I'm not talking about the expense side, I'm payable side. Whether any present obligation is there? Yes. So what is a past event? I have already engaged the auditor. You cannot say that, sir, I have not taken the service. So how can it will become a present obligation? This is something where, of course, once you complete your accounts, only then the auditor will perform the service, right? But you have already engaged the auditor. Auditor has already planned his team, right? And you have already engaged the auditor, and you have already entered into the contract with the auditor that once I'll complete my books of accounts, auditor will come and audit the books of accounts, right? In many cases, you must have seen the auditor has started performing some task also, physical verification, cash counting on the reporting date, right? The auditor is doing all these services. In case of listed company, they are doing this on a quarterly basis, right? Some auditors are doing off cycle audit, right? For example, they send their articles or CAs on in the month of January or February, right? So that the workload will not be there in the month of April, right, friends? But the point is, what is the past event in case of the engagement with the auditor? There is a contract. The auditor has already been engaged, hired, right? And of course, there is a present obligation. They will audit the current period account. They will issue the audit report. Then only we will be able to publish our results, right? So there is a present obligation due to the past event, and of course, outflow of the resources is certain, right, guys? Is it clear or not clear? Outflow of resources embodying economic benefit means economic outflow is there, right? So you will not say ki, I'll not pay you the money, but I'll help you whenever required. So I'll help you whenever required does not mean that the economic benefits are there is an outflow of economic benefit. For example, Koshiki is saying, sir, I'll provide some services to you. Okay. I'll teach you FR. Koshiki is saying me. I said, okay. So instead of paying tuition fee to Koshiki, I am saying that Koshiki, don't worry. I'll give you 5 students, or I'll help you whenever required, right? In this case, for me, the outflow of resources are not certain. It is not something which is embodying economic benefit, right? It is not something which is embodying economic benefit. So hence there is no any liability, right? Is it clear? So we understood liability, and give me any example. I'll set that example and I'll fit this example in this 3 scenarios, right? But what is the difference between a provision as a liability and a liability? So the provision is a liability of uncertain timing or amount. Either timing is uncertain or amount is uncertain. So friends, if I break my liability, the liability has to be broken into 2 parts. Liability. One, the liability which is certain. Second, the liability which is uncertain. The timing or amount is certain, and the timing or amount is uncertain, right? For example, audit fee, for example, trade payable, for example, accrued expenses. So the timing and amount is certain. What could be uncertain? Asset retirement obligation, or let's take an example of warranty. For example, I'm having a OnePlus phone, right? OnePlus 9 phone. I got a warranty of OnePlus 9 phone for a year, right? So the company which is OnePlus, the company which is selling OnePlus 9 phone, of course they have to incur some expenses also during the warranty period. For example, there is a problem which comes in the screen, which comes on screen, right? So there is a faulty screen. So now the company has to replace that faulty screen. For example, there is a problem with touchpad. The company has to replace the entire touchpad. Like in my Samsung phone. So I have purchased a Samsung phone worth 70,000 rupees just 4 years back, and I got some problem in the touchpad of that phone, right? And I went to the service center and I have asked about that. What is the replacement price? What is the if so? What is the problem? First of all, they told me that your touchpad is faulty and it has to be replaced. I asked what is the price for that. They told me 18,000 rupees, 18,000 rupees. But I told them no, 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 I will not pay this because my phone is in warranty period. So they told me just leave this phone for 5 days and we will get it replaced, right? So friends, the cost was 18,000 rupees, but it was replaced free of cost to me. Why? Because it was in warranty period. Now the question arises, let's say Sumit is an auditor of a Samsung company, right? The Samsung has sold 50,000 unit of mobile phone, and Samsung has not created any expense or any provision for future replacement. So now Sumit is an auditor. Sumit asked to the accountant that boss, you need to create some provision. And the accountant asked Sumit that Sumit, we just have sold the phones. So how can I create this provision? So then Sumit told him, see, you have sold your phones with a condition, with a commitment, with an obligation. So he asked, what is the obligation? What is the commitment? Sumit told him that the past, you have already incurred a past event that you have sold a phone with warranty, right? Since you have sold a phone with warranty, you have a present obligation. He asked, what is the present obligation? Sumit told him that you have a present obligation to make good the damage or make good the damage or repair or damage or loss which which is which is arising on your product which you have sold, right? So you have given a commitment for the next 1 year. Okay, so he understood that present obligation is there, past event is there, and of course if it will result in the outflow of resources, the probability of outflow of resources is also there. I'm not saying it will happen, and that is why the timing or amount is uncertain, right? So then the accountant is saying, boss, but I don't know that how much amount of repairs or replacement will come to me. I have sold 50,000 rupees, whether 2,000 people will come to me, 3,000 customer will come to me, 100 customer will come to me. I don't know that what could be the amount of repair. Is it something which is only related to a screen? Is it something which requires very minor repair, right? I don't know. So I'm not aware about the amount, or even I am not aware about the timing also. I am not aware that whether this will happen in this month, next month, or when. I'm not aware, right? So in that case, Sumit is saying him, boss, as per the requirement of Ind AS 37, since you are not aware or certain about the timing or amount, that is why it is not your trade payable. It is not your accrued expenses, but you have to create a provision on the basis of best estimate. Now the question arises, how this best estimate can be determined? The best estimate can be determined on the basis of past precedent, on the basis of industry precedent, right? For example, if this Samsung is a very old company and every year they are selling some phones, and they know that whatever amount, whatever quantity I am selling, right? So there could be a, there could be a situation where I end up incurring a cost worth 5 to 10% of my sales, right? So every company is doing like this. So they have to create a provision on the basis of the past precedent, on the basis of the average of the last 3 years, 5 years, whatever it could be, right? Or they can say that normally in the industry, so this is in this electronic market, normally 5% comes as a repair or return, right? So they will create a provision on the basis of that estimate. But the moral of the story is they have to create a provision. Okay. The second example, like Indus Tower Limited or all these telecom tower companies or Reliance Industries, right? Oil and gas industries. They are creating provision for asset retirement obligation. How they are creating the provision for asset retirement obligation? So friends, in case of Indus Tower, let's say they are installing a tower for 20 years. Since today they are installing a tower, they are aware that after 20 years, I have to dismantle this tower. And when I will dismantle the tower, I will incur a dismantling cost. Whatever civil work, whatever foundation I have created, I have to restore this place in the same condition in which the landlord has given it to me. Right? So there is a huge dismantling cost. In case of oil and gas, there is a huge dismantling cost, site restoration cost. So if I talk about the timing, probably timing is certain that it will arise after 20 years, right? After 20 years, but amount is uncertain. You are not aware that how much you are going to pay after 20 years on account of this site restoration obligation. You are not aware how much amount you are required to pay after 20 years. So friends, that is why this is a provision. And the word used is not and amount. The word used is or amount. Have you understood? The word uses or amount. A provision is a liability of uncertain timing or amount. Guys, I hope you have understood this concept. Yes or no? I have given you enough examples, enough explanation. Have you understood this concept? Yeah. So when a provision is going to be recognized, now we are discussing the recognition condition. And the recognition condition comes out from this liability definition only. There must be a present obligation. This present obligation could be legal obligation, could be a constructive obligation. I'll talk about this thing. Second, obligation can be estimated reliably. A reliable estimate can be made. First, present obligation could be there. Present obligation should be there. Second, reliable estimate could be there. For creating a provision, of course, you need some amount. And for that amount, you have to do some estimation. So if it can be estimated reliably, only then the concept of provision will come into the picture, right? For example, the company is into a new business and the product is also new. The company does not have a historical experience. There is no historical experience from industry perspective also. The company is not able to determine that how much repair or replacement will come on in the warranty period. So the company is not able to estimate any replacement cost reliably. So in that case, it will not be, the provision will not be recognized. The disclosure will be made that since the company is into new business and the industry is also new and the company is not able to reliably estimate the amount of provision which is arising due to this fact, right? So what are the recognition condition? First, present obligation due to past events should be there. Second, reliable estimate can be made. Third, outflow is also probable. Probable means more than 50% chances is there that you have to end up paying this amount. Outflow is also probable, right? Where you are saying that, for example, in case of warranty, present obligation is there. Yes. Why? Because you have sold a product with a warranty paper. Second, whether reliable estimate can be made. For example, you are making a reliable estimate on the basis of last 5 years of the data, right? So you can make an estimate with that. Third, whether outflow is probable. Yes, outflow is probable. Why? Because in the past history, you have seen that we end up paying this amount, right? And you are taking the average of that. And of course, it is best estimate. I'm not saying this is an actual amount. This is an estimate, right? So with that, you can say that yes, outflow is also probable. There are more than 50% chances. Probable means more than 50% chances that you will be end up paying this amount. Guys, if you will see the difference between a liability and a provision, there is difference of one word, and the word is probable. In liability, the word is the settlement of which is expected to result in an outflow of resources. But for the provision, the word used is probable, right? Because it is a provision. It could be a scenario where the Samsung has sold 50,000 phones, or even 50 customer will not come for the repair or replacement, right? Or there could be a scenario whether within 1 year there will not be any problem, or the problem is very minuscule. The fault is very minuscule, which can be repaired without any cost, right? For example, formatting the phone, updating the software, right? Upgrading the software. For example, I went to OnePlus 9 showroom and I told my phone is very slow. There is some problem in this phone. That customer care guys or service center guy just look at my phone, reset the phone, upgrade the software, and it becomes okay. There is no cost, right? Are you getting me? So that is why you cannot say that every provision has to be settled, right? But on the basis of past precedent, we are saying that yes, it is probable that the outflow of resources will happen, right? And that is why the word certainty has with certainty has not been used. The word probable has been used, right? Okay, clear? Now let's discuss this part one by one. Present obligation. Now this present obligation could be by two way. Present obligation. This present obligation could be legal obligation or constructive obligation. Let's understand what is meant by legal obligation and what is meant by constructive obligation. And I'll make you understand with the help of an example. First, what is meant by legal obligation? You are legally obliged to pay, right? Contractual. So this legal thing comes out of contract, out of legislation, out of regulators, out of provisions of law, right? So legal obligation means you are legally obliged to pay. You are contractually obliged to pay, right? What is meant by constructive obligation? Constructive obligation means you are not legally obliged to pay, but on the basis of established pattern of past practice, on the basis of published policy, on the basis of commitment, right? On the basis of past practice, published policies, commitment, okay? The entity has created a valid expectation. The entity has created a valid expectation that this entity will discharge its responsibilities. Sir, what does it mean? Have you heard about? So I'll give you a real life example. When you go to the showroom, this garment showroom, right? For example, Louis Philippi, Allen Solly. So they says that during the sale period, they will not entertain any refunds or replacement, right? So they are just writing that on the signboard. There was a showroom in the Kamla Nagar. Kamla Nagar is a place in Delhi. So there was a showroom in Kamla Nagar, and that showroom also says that we will not entertain any replacement or refund during the period of sale. But generally, that showroom used to entertain the replacement or refund even in the sale period because of their better policies, right? Because of their customer satisfaction, right? So I still remember just 3 years ago when I was, shopping. I was just doing the shopping with my wife. My wife told me that purchase let's purchase the stuff from Ellen Solly. This is a very good shop and they used to entertain the replacement or refund also, right? If you will not like the product or if there is a problem in the product, it will get replaced also. So if I talk about legal obligation, that Ellen Solly showroom is not legally obliged to entertain the entertain the replacement or refund. But if I talk about the constructive obligation, by his conduct, by his past practices, by his commitment, he has created a valid expectation in the minds of myself and my wife that yes, he will entertain the refunds or replacement, right? This is the meaning of constructive obligation. Now, I'll explain these two things with the help of an example. there is a company X Limited, and the company, when the company is hiring its employees, the company has uh, when the company is hiring its employees, the company has in the offer letter, the company is writing that your salary will be 10 lakh rupees, 9 lakh rupees we will pay you as a fixed, and 10% we will pay you as a bonus, right? And they're writing that 10 lakh rupees is your CTC, so we will give you 1 lakh rupees of bonus, provided you will your minimum rating is A3, minimum rating, right? So any employee who is meeting at least A3, he will get the bonus whatever is written in on that CTC document, on the employment offer letter, right? There is another company Y Limited. The Y Limited is saying all fixed, right? We will pay you 10 lakh rupees fixed. So of course they have to create a expense for 10 lakh rupees. They have to pay 10 lakh rupees during the period. But normally what Y Limited does, in the last 4-5 years, Y Limited says that, or even at the time of employment, Y Limited also says that, see, we are having a fixed model plus variable model, right? We'll pay you 10 lakh rupees fixed. But on the basis of performance of the company, on the basis of your performance, you will get some variable also, right? So guys, tell me one thing. In the first case where 1 lakh rupee as a variable was written on the offer letter, and in the second case where normally company was paying variable, right? But the company has not made any commitment to pay. So basically, it is not written in the offer letter. It is only written that variable will also be payable on the basis of the performance and rating of the company and employee. So guys, in the first case, since that 1 lakh rupees was written on the offer letter, this 1 lakh rupee, although variable, but it is the company is legally obliged to pay if the employee is meeting certain rating criteria. But in the second case, we have seen that in the last 5 years, the company is paying, let's say, whatever profit is there, the company is distributing 10% of the profit to the employees, or the company is also paying variable in the tune of 5 to 10%, right? So in this case, although the legally commitment is not there, but as per the past pattern, past practice, companies publish policies, right? The company has to create a provision due to the presence of constructive obligation. Have you understood? Due to the presence of constructive obligation, right? Second example, let me take the second example. For example, there is a company which is a steel plant, and that steel plant is locating in let's say Jindal Steel and Power Limited, right? So Jindal Steel and Power Limited, Jindal Steel and Power Limited is operating in Raigad, okay, in Raigad, okay. So they are having some chimneys which are doing the carbon emission, okay, and the law says that the Chhattisgarh law or the Raigad law says that if you will emit the carbon emission up to after or beyond a certain threshold, if you will emit a carbon emission beyond a certain threshold, you are entitled for a penalty of 5 lakh rupees, right? You are entitled for a penalty of 5 lakh rupees, right? The department may send a notice to them for seeking an amount of 5 lakh. This is the first case. So tell me, if the Jindal Steel and Power will emit certain level, beyond a certain level of carbon emission, whether they are obliged to pay 5 lakh rupees? Answer is yes, because it is the law. Second, there is no law in the state. There is no regulation, no law. But Jindal Steel says that in their commitment towards environment, in their commitment towards society, and they have a published policy which says that we will always try to restrict the carbon emission up to this cubic threshold. If the carbon emission is beyond that threshold, we will spend money in making the environment good, and we will spend money in planting more and more trees. So we will invest whenever the carbon emission goes beyond a certain threshold, we will invest 10 lakh rupees in the environment, right? Now friends, tell me, Uh, in the former case, in the first case, there was a regulation which says that beyond a certain threshold, you have to pay 5 lakh rupees. In the second example, there was a policy of Jindal which is already published policy, right? And that published policy has created a responsibility, right? That has created expectation in the mind of the stakeholder that Jindal will make the environment good, right? Whenever this emission will happen. So guys, tell me, second example is an example of legal obligation or a constructive obligation. This published policy, this example is an example of constructive obligation. The first one, 5 lakh rupees of penalty, is an example of legal obligation. So let's say Viraj is an auditor of Jindal Steel and Power Limited. So when Viraj was auditing, Viraj has asked from the manufacturing vertical that please let me know how much carbon emission has happened, right? So they have told that, sir, carbon emission is let's say 1 lakh cubic this thing, okay? So he told that since you got a threshold of 80,000 and it is 1 lakh and there is a law in the state, so why you have not created any provision for penalty? So then Jindal says that the accountant said to the auditor, who is Viraj, sir, we haven't received any notice for that. Then Viraj said, boss, this is a legal obligation. You have already made a default. You have already made a violation, and you have to recognize a provision of 5 lakh rupees, let's say, right? So then the accountant said that, sir, normally we don't receive the notice. Okay. Normally we don't receive the notice. Then Viraj is saying, but the outflow is probable. There are high chances where you got the notice and then you have to pay, right? So since it is a legal obligation and the past event is you have a present obligation, because you have already, there is an obligating event which is you have already emitted carbon emission beyond a certain level. So past event is there. And what is the obligating event? There is a legal obligation. Why? There is established law, right? Outflow is also probable and amount is also measurable, because we are aware that you have to pay 5 lakh rupees. What is meant by constructive obligation? Again, there is no legal obligation. But now again, Viraj is saying, boss, you have to create a provision. Accountant is saying, why, sir? There is no legal obligation. But Viraj is saying, look at your policies. You have already published your policies on your website also, right? According to this policy, you have to create a provision of 10 lakh rupees. You have to make this investment in the environment to make this thing good, right? So guys, legal obligation and constructive obligation, these two are the examples, these two are the sub verticals of present obligation. So provision is required to be recognized even though constructive obligation is also there, right? Is it clear? Is it clear, friends? I hope you guys have absolutely clear regarding the constructive obligation part also, right? So it's 8:30 now. Let's take a break, and after break, let's take a 10 minutes break, and at 8:40 we'll start the session again. we understood the meaning of present obligation, legal obligation, and constructive obligation. Let me know if you have any questions so far. Viraj is asking, sir, in case of Maggie, where the company in 2015, where the company was required to, uh, called off all these Maggie packets and they have destroyed these Maggie packets. So in that case, which Ind AS was applicable on that? So Ind AS, so basically Ind AS 37 was applicable, Viraj, because they have to call for this entire Maggie packets and they have to destroy that Maggie packets on account of this unsafe and hazardous item. So of course Ind AS 37 was applicable. They have created a provision and then they have also they have also removed their inventory for that. Legal obligation arises from outside, but constructive obligation from inside policy. Very good, Sumit. So Sumit has given a very good the either of the party can go to the court of law as well, or it is from the outside of the organization, means from the regulators, from the authorities, right? But constructive obligation is something which is created inside the organization, means from the policies which are created from the organizations, right? So leases a cell site and build a base station on the site, right? It is required to reinstate the land at the end of the lease. The lease term is 50 years and the operator expects to relocate the base station at the end of the lease term. Friends, operator Vodafone, not Vodafone, it is VF. Let's not talk it as a Vodafone. Operator Vodafone or VF is a mobile operator that leases a cell site and build a base station on the site, right? It is required to reinstate the land at the end of the lease. So basically this is the site and this company has taken this site on a lease for 50 years. And this company has created a tower station on this site. This company has created a tower station, right, on this site. So the lease term is 50 years. And when it will go after 50 years, it has to dismantle this thing. It has to dismantle the tower and it has to restore. It has to restore this land in the same condition in which it was given to this company, right? So the company will have an asset retirement obligation, right? So now the question is whether at the beginning of the lease, whether the company is required to create any provision. Tell me, guys. Tell me whether the company is required to create any provision. Yeah, it is a provision because the timing is certain, but the amount is uncertain, right? We don't know after 15 years what is the amount which this company will incur for decommissioning, restoring of the land, restoring of the site, dismantling of the tower, right? So the company is not aware as of today what will be the amount. And of course, in that case, this amount has to be estimated, right? So how this amount could be estimated? For example, the company may say that if today, for the same site, if today I'm incurring a cost of, let's say, 1 lakh rupees. So what will be the cost after 50 years? Probably if the inflation rate is, let's say, 6%. So if I'll compound with the inflation rate, what is my current cost of expenditure? What is my current cost? So it will give me the future cost, a future estimated cost, right? And if I'll discount that future cost, it will give me the present value of the future obligation, right? So this is how I can estimate. But the point is whether the provision is required to be created in this case. Yes, provision is required to be created in this case, right? So one of the participants is saying there is a network issue. Am I able to am I audible now? Are you able to hear me properly? Yes. So 4-5 participants have confirmed they are able to hear me. Okay. Yes, guys. In this case, this is a asset retirement obligation and provision is required to be created. Okay. Yes, VF should measure the likely asset retirement obligation and add its present value to the asset as leasehold improvement. This present value of the obligation is unwinded over the period through interest cost, right? And how this accounting has to happen? Let me show you the accounting, okay? And please let me know if my Excel file is visible. Please let me know if the Excel file is visible. Whether the Excel file is visible, guys? Is it visible now? Yes. For example, let's discuss this example with the help of these numbers. Case study on asset retirement obligation. The company has constructed a tower on first 50 years, right? And the company has estimated that dismantling cost incurred today is approx 1 lakh rupees, right? So today cost is 1 lakh rupees, but it has to incur after 50 years. And the inflation rate is 7%. The inflation rate is 7%, right? Friends, if the inflation rate is 7%, it has to incur the cost after 50 years, and current cost is 1 lakh rupees. So we are calculating what is the value of money, what is the value of money if today it is 1 lakh rupees, what is the equivalent amount after 50 years if the inflation rate is 7%. Estimated dismantling cost at the end of 50th year is 1 lakh multiplied by 1 lakh multiplied by 1 plus 7% to the power 50, right? So I am calculating the future value which is after 50 years. It is coming out at 29 lakh 45,703. If you deposit 1 lakh rupees today in a bank, and if the bank is giving you 7% interest, after 50 years, this 1 lakh will become 30 lakh rupees, approximate 29 lakh 45,703 rupees. Or you can say that 1 lakh rupees today is having an equivalent value of 30 lakh rupees after 50 years, if the inflation rate is 7%, right? Now the question arises, okay, we have calculated what will be the future value on the basis of current value considering the inflation. So do we need to account for this 30 lakh rupees provision today? Answer is no, it is not. It will not reflect a true picture because you yourself is saying it is 1 lakh rupees today, right? But tomorrow, if it is 29 lakh 45,703 rupees, so at what value you have to create a provision in the books of accounts? Standard says that in case of a long-term provision, the provision has to be taken on the basis of time value of money. It means the provision has to be taken on the basis of discounted value. Now, what is the discounted value? Standard says that discounted value you have to consider from the perspective of discounting the future obligation, and you have to consider the discount rate. And what is a discount rate? It is an interest rate. Discount rate is an interest rate. So this discount rate is different from the inflation rate. Okay. For example, in this case, the discount rate or weighted average cost of capital for the company is 10%. Now, what is the present value of the future dismantling cost? 9,45,703 divided by 1 plus 10% to the raise to the power 50, right? See, the present value of 29,45,703 rupees as on today is 25,093 rupees, right? So friends, in your PP standard, you have already read that, you have already understood that in case of a property, plant and equipment, if there is any dismantling cost, it has to be added to the cost of the asset. On the day one, what should be the accounting entry? On the day one, the accounting entry is PP account debit to provision for ARO, asset retirement obligation, which is this ARO is as 37, and this PP as per Ind AS 16, right? Now, how this 25,000 will become 29,55,703 after 50 years? Let me show you the schedule 50 years, right? Let me show you the schedule for 50 years. This is year, and let me plot 50 year here. 1. So this plus 1, right? So let me put 50 till the 50 years. And let me show you how this entire working has to happen. Okay. So opening. What is the opening value? Opening value is 25,093, which is present value. Opening. And this 25,000 will become 25 lakh after 50 years. This will become 29 lakh after 50 years. It means there will be an interest component also, right? Interest has to be charged at the rate of 10%, right? The rate on which the discount has been done, the discounting has been done. At that rate, the undiscounting has to happen. The unwinding of discount has to happen. So let me take this. Let me remove the decimals, right? So this closing of 27,000 will become opening of the second year. Interest has to be charged at the rate of 10%, and this closing will be there. So on and so forth, all the working has to happen. And at the end of 50th year, you will found that this has become 29,55,703, right? Right? So over the year, the differential has to be charged. 29,20,000 has been charged as an interest cost, right? So interest cost will be debited and provision for ARO will be credited, so that it will become 29,45,703, right? If I'll add 29,2609 in 25,093, it will comes out at 29,45,703, right? What is the accounting entry every year? The accounting entry interest account debit. For example, the accounting entry for every year interest account debit to provision for ARO account. In the first year, it will be 2509, or I would say in all the 50 years, the accounting entry would be interest account will be debited by 2920 and provision for ARO will be credited by 2920, right? And this way, this 25,000 has to be created as a provision on the day one. It has to be unwinded, means interest cost has to be factored, and this provision will start getting shoot up, right? On the 50th year, sir, what happened? Because this is the best estimate. Instead of 29,45,000, let's say only 25 lakh rupees of expenses or outflow will happen. So in that case, the 4,45,703 provision is going to be reversed, and it will be credited to other income, right? Is it clear? Or let's say instead of 29.45 lakh, let's say the actual expense comes out to 35 lakh, then the additional amount has to be taken to the expense, right? At the time of actualization. I hope this working. I hope this concept, and this is not only ARO concept. This concept is for every provision where it is beyond 1 year, where the time value of money is material. This is for everything, right? Second example, the company, there was a legal claim. For example, there was a legal claim. Example 2, right? The company has lost a case where the company has lost a case as on 31st March 2021. It has to pay 20 lakh rupees after 2 years to the customer. Who was an aggrieved party, right? Advise the creation of provision in the books of the company. In this case, this 20 lakh rupees has to be paid after 2 years, right? First of all, in this case, provision for expense account debit, provision, because due to the verdict announced by the court, the provision for expense has to be debited to provision, which is liability, right? But what is the value as on 31st March 21? What should be the value? What is the value as on 31st March 2021? What is the value? The value will not be 20 lakh rupees. For example, in this case, the discount rate is 10%, right? You need to create a value. In this case, you have to compute the present value of future outflow. 20 lakh, 1, 2, 3, 4, 5, divide by 1 plus 10% to the power 2. It is coming out at 1652,893, right? 1652,893. Okay. In this case, the provision for expense has to be created at 1652 and the liability has to be created at 1652 on the day one. Now, what will happen on 31st March 22? That is the next year. 31st March 22, that is next year. And 31st March 23, when this provision is going to be paid, when this amount is going to be paid, 31st March 23, what will the accounting entry? Friends, in this case, how this thing has to be done? 1, 2. This is the year. Let me do the calculations here. So year, opening, interest, and closing. So the opening is 1652. Interest will be charged at 10%. Unwinding has to happen. This plus this. Let me remove the decimals. Right, this will become 20 lakh rupees. So on 31st March 22, the accounting entry will be interest cost account debit, interest cost debit to provision liability account. So this will be credited. What is the interest amount? 165289, and liability has to be added to this from this 165289. Again, on 31st March 23, same entry has to be repeated, but the number will be different. In the second year, the interest cost will be higher than the first year, right? At the end of the 2 years, this provision liability will become 20 lakh rupees. Now the payout has to happen. So what is the next entry? Provision liability account debit to cash account. And now it has to be paid by 20 lakh rupees. I hope it is clear to all of you guys. I hope it is clear to all of you. Koshiki is asking, is not it be a liability instead of provision as timing and amount is certain? Basically, Koshiki, you are right. But why we are saying that it is, so basically if the court has announced a decree, it becomes certain, right? So it will become a liability, but this liability has to be discounted for. But if the court has not announced and the company and the legal counsel or the company is considering that we may end up paying 20 lakh rupees after 2 years, we may, right? In that case, it is plain provision, right? But in this case, you are right. Okay. So why I have taken this example just to explain you the understanding part, right? But you are right. If the timing and money both are certain, it will not be a provision, right? But how it has to happen? So I've just explained you in this manner, right? it will be a liability. Okay. I think estimate change for 50th year ARO, I have already explained that in the 50th year, if the value of the ARO will increase or decrease, the impact has to be taken in that year only. Yeah. Rashmi, is it clear? Is it clear? Reason, you have to look at three things. Present obligation should be there, either legal or constructive. Second, outflows is probable, and second, amount is measurable. Present obligation, outflow is probable, and amount is measurable, right? I hope it is clear to all of you now, guys. Is it clear to all of you? Yes. Okay. Let me go back to my presentation again. What should be the wording if the provision word is not applicable? In that case, you have to just write expense, right? Accrued expense, or let's say compensation, expense for compensation, right? Or compensation expense, other expense, legal expense, right? Is it clear, Sumit? Let's say compensation expense account debit to compensation payable account. Okay. Yeah. Is it clear, Viraj? Yes. Let's discuss this case study now. ABC is an automobile component manufacturer. The automobile manufacturer has specified a delivery schedule, non-adherence to which will entail a penalty, right? So ABC is a automobile component manufacturer, and this manufacturer has specified a delivery schedule, non-adherence to which will entail a penalty. As on 31st March 2016, which is the reporting date, the manufacturer has a delivery scheduled for June 2017. The manufacturer has a delivery scheduled for June 2017. However, the manufacturer is aware that he will not be able to meet the delivery scheduled in June 2017. So friends, as on 31st March 2016, the reporting date, the manufacturer has a delivery schedule. So we are preparing the accounts for 31st March 2016. And there was a delivery schedule which is given by the manufacturer. And as on 31st March 2016, the supply is going to be done on June 2017. It is going to be delivered on June 2017. I am talking about 31st March 2016, right? However, the manufacturer is aware that he will not be able to meet the delivery schedule in June 2017. Right? Determine whether the entity has a present obligation as at March 31st, 2016, requiring recognition of a provision. So guys, for example, let's say Tata Motors Limited. Tata Motors Limited has entered into a contract with Infosys Limited that we will supply you 10 cars, right? We will supply you 10 cars by June 2017. And this contract was entered in the financial year 15-16. So as on 31st March 2016, the Tata Motors is aware due to some problem in the supply of raw material or manufacturing process. Tata Motor is aware that he will not be able to supply this 10 vehicles to Infosys by June 2017, right? And if they will not be able to supply by June 2017, in that case, the penalty will arise. Tata Motors has to pay the penalty, has to pay the penalty to the Infosys. Now the question arises on 31st March 2016, whether the company has to create a provision assuming the company will end up paying a penalty of 5 lakh rupees to Infosys. So for provision, what you need to see? Present obligation arises out of past event. present obligation arises out of past event? Guys, tell me, on 31st March 16, can Infosys ask about the penalty on 31st March 2016? Of course, the event has not happened. It is expectation of Tata Motors that he will not be able to deliver. But let's say the raw material crunch was going on. Let's say everything will be stabilized. They will be able to deliver. So as on 31st March 2016, Infosys cannot demand that money. Infosys cannot say that, even I am thinking that you will not be able to supply by June 2017. Please pay me penalty as on today only. Answer is no. Right? There is no present obligation. There is no, as on 31st March 2016, Tata Motor is not obligated to pay. Tata Motor is not obligated to pay this penalty. Tata Motor will only be obligated to pay that penalty on the date of June 2017, right? When the delivery actually not happened. Have you understood? So in this case, there is no present obligation due to past event, and hence the provision is not required to be recognized on June on 31st March 2016. Right, guys? Is it clear? In this case, there is no present obligation arising out of past event, as the goods are scheduled for delivery in June 2017. There is no delay as on March 31st, 2016. Hence, there is no present obligation to pay the penalty in the current year. Therefore, no provision can be recognized in the instant case. Right? You are right, Koshiki. It will nowhere be recorded. Right? Very good. Absolutely perfect, guys. Yes. Guys, this case study we have discussed about the present obligation. This present obligation should be there. In this case study, we have discussed about the present obligation due to past event, because the company has installed the tower, the company has entered into a contract, right? And that is why the present obligation is there, past event is there. The only thing is outflow will happen in future. That's all, right? In case of this tower site, in case of the delivery schedule, the present obligation is not there, and hence this entry is recorded nowhere. This entry is not recorded. So first part, present obligation arising out of past events. Second, outflow should be probable. It should be measurable. It should be probable. Let's discuss about the probable. Okay. In this case study, we will discuss about the probability. Probable. What is meant by probable? More likely than not. More than 50% chances of happening. After a wedding in 2010, 10 people died as a result of food poisoning from product sold by Kim Catering Company. Right? Legal proceedings started seeking damages from the company. So 10 people died as a result of food poisoning. Up to the date of authorization of the financial statement for the year ended December 31st, the company's lawyers advised that it was 40% chances that the company would not be found liable. Please read this line again. So in 2010, this catering company has supplied foods, and due to the stale food or due to the infectious food, 10 people died due to the food poisoning. Right? And the legal proceeding was started, and the company's lawyers advised that there are 40% chances that the company would not be found liable. There are 40% chances that the company would not be found liable. Means there are 60% chances that the company would be found liable. Means outflow is probable. It is more likely than not, right? So 40% they are not liable, but 60% they will be liable. It means, however, when the company prepared its financial statement for the year ended 31st December 2011, their lawyer advised that owing to the development in the case, it was 80% chances that the company would be found liable. See, both the statement are reverse statement. In 2010, 40% not liable means 60% liable, means probable. This case is probable. In 2011, due to the development in the case, 80% they are found liable. Means again it is probable. Assuming the attorneys can arrive at a reasonable estimate. So they are saying they can arrive at a reasonable estimate that what should be the compensation of the potential damages. Should the company recognize a provision as per Ind AS in 2010 and 2011? Tell me. So present obligation is there, yes, due to the past event. The past event is the supply of food, right? And the food was infectious. The people got died. The people died. So there is a present obligation arising out of past events, right? Arising out of past events. Okay. And the outflow is probable. Yes, it is probable. There are 60 and 80% chances. There are 60% and 80% chances that the payment has to be made, right? Because their lawyers are advising. And in the question, it is also given that the reasonable estimate can also be made. So whether provision is going to be recognized? Yes, it is going to be recognized. In 2010 and 2011, you can recognize a provision for this situation. Using Ind AS, probable indicate that an outcome is more likely than not to occur. Means more than a 50% chance of occurring. Since this situation is above this threshold in both the years, a provision would be required to be recognized. Right? Is it clear? Is it clear, friends, or not clear? Clear? Okay. Let's discuss a case study on constructive obligation also. The case study is more on an environmental policy for a contaminated land. An entity in the oil industry operates in a country with no environment legislation. Right? There is an oil industry, and this oil industry operates in a country where no any environment legislation is there. However, it has a widely published environmental policy. The company has widely published environmental policy in which it undertakes to clean up all contamination that it causes, and it has a record of honoring this published policy. So past practice is there, past precedent is there, published policy is there. During the period the entity causes the contamination to some land in this country. So this oil industry has contaminated some land. Although there is no environment legislation, but they have a published policy that they will clean up all the contamination that it causes, and they have a record of honoring this also. Tell me whether provision is required. Yeah, it is a constructive obligation. It is not a legal obligation, but it is a constructive obligation. Yes, it is required. In these circumstances, the contamination of the land gives rise to a constructive obligation because the entity, through its policy and record of honoring it, has created a valid expectation on the part of those affected by it that the entity will clean up the site. Clear? Any doubt, guys? Any doubt? I hope it is clear to all of friends. Good. Okay. We understood the meaning of provision, and we have also understood how to discount a long-term provision. How to discount a long-term provision. What are the accounting entries for provision? Right? It has to be a discounted value, and the unwinding of discount will be recognized as an interest cost. Right? It has to be recognized as an interest cost. Clear? Right? In case of that future example of future penalty of 5 lakh rupees, Koshiki, which example? Future penalty 5 lakh. Are you talking about if there is an environment legislation and the company has contaminated a land? Are you talking about that? If there is an environmental legislation of 5 lakh rupees penalty, are you talking about that, Koshiki? So in that case, it will be a provision, not a contingent liability, right? Because there is a law, established law that you have to pay if you have made a violation, right? It will be a provision, not a contingent liability. Now discuss what is meant by contingent liability and what is meant by contingent asset, friends. Right? So what is window? And we will be discussing the measurement of provision after understanding contingent liability and contingent asset. Okay. Students, are you able to hear me properly? Or is there any problem? Is there any disturbance? Because one or two participants are saying they are facing some disturbance. Are you able to hear me properly? Are you able to see the slides and Excel file properly? Koshiki, is there any disturbance? Please let me know if there is any disturbance. Pooja is saying there is no disturbance. Okay. Even Rahul has confirmed there is no disturbance. So guys, let me do one thing. Let me switch off my video, for some time. And I think you guys also have to see your internet connection probably. Okay. Let's talk about the contingent liability, right? Let's talk about contingent liability. What is meant by contingent liability and how is it different from provision? How is it different from provision? Okay. First of all, let's talk about the condition of provision. The provision is going to be recognized when three conditions will be satisfied. Present obligation arising from past event, outflow is probable, and outflow is measurable. Right? You can measure the amount. You can you are certain, or I would say it is more chances, more than 50% chances are there that this outflow will happen. Okay. So friends, in this particular case, in case of a provision, present obligation is there, right, as a past event, and two condition, outflow is probable, and outflow is measurable, right? Amount is measurable. These two conditions should be satisfied. So if there is a present obligation arising out of past event and the outflow is not probable, So the company is saying there are not, in case of let's say Kim Catering Company, their legal counsel will say that there is very less chances where you end up paying this compensation to the deceased, right? Their legal counsels are saying we have sent the food to the laboratory and the food was of a hygienic quality, right? So we have a very strong case and there is a very less chances where we end up paying some penalty, right? Where we end up paying some compensation to the deceased. Okay. So in this case, the present obligation arising out of past event is there. Outflow is also measurable, but the legal counsel are saying outflow is not probable. There are less than 50% chances where we may found liable, right? So in this case, if any of the condition will be defeated, either outflow is not probable or outflow is not measurable, this provision will be, this amount will not be shown as a provision. This amount has to be shown as a contingent liability, right? If outflow is not probable. Second, the company is saying, I know there is a present obligation due to past event. I know I will end up paying some compensation, but I'm not able to determine the amount. I'm not able to estimate what amount I am required to pay, what amount I will be liable to pay. It means outflow is not measurable. In this case, outflow is not measurable. So provision cannot be recognized. In this case, it has to be shown as a contingent liability. Sir, if outflow is not measurable, then how will you show the contingent liability? Friends, in that case, quantitative disclosure will not be there, but qualitative disclosure will be there, where the company will disclose that there is a case going on for this thing, and the present obligation is there, outflow is probable, but due to this XYZ circumstances, we are not able to measure the measure the outcome of the case, right? We are not able to measure the outflow which will happen in future, and hence we are disclosing this as a contingent liability. Is it clear to all of you guys? So present obligation, what is a contingent liability? Is a present obligation arising from a past event of which outflow of economic benefit is not probable, or this cannot be measured reliably. Means if these two conditions, either of the two conditions of the provision is not getting satisfied, it is not meeting, in that case this provision will shift it to the contingent liability. Is it clear, Viraj, Smith, Kochiki? Is it clear? I hope you guys are able to hear me properly. Is it clear? Shall I move forward? Okay. So when a provision will become a contingent liability if either outflow is not probable or outflow is not measurable. But there are two definitions of contingent liability, not only one definition. So this I have taken first. Why? Because I have already told you the meaning of the recognition condition of provision. Second, contingent liability is not a present obligation. It is a possible obligation. It is not a present obligation. It is a possible obligation. Okay. Possible obligation arising from a past event, which is required to be confirmed by future event, not fully within the control of the entity. Possible obligation, right, arising from a past event, which will confirmed by the future event, not fully within the control of the entity. So present obligation is not there, possible obligations are there, right, which is depending upon the happening or non-happening of some future event, right? Happening or non-happening of some future event. Is it right? Is it clear? So those has to be shown as a contingent liability. Now, what is the difference between possible, probable, and remote? Right. Let's talk about first of all conditions so that you will be able to understand this. So guys, for example, let's forget about the contingent assets, discuss contingent liability and provision first. Likelihood of the outcome. For example, there are 95% probability that this outcome will happen, this outflow will happen. So in that case, this will be the provision. It is more than 50%. If it is probable means more likely than not. So guys, greater than 95% probability is considered as a virtually certain, right? Of course, it will become your liability. It will become your provision. Again, if it is probable means more likely than not, means more than 50%, but up to 95%. Again, in this case, you have to recognize a provision. But what is meant by possible? Possible obligation means there is more than 5% chances, but up to 50%, right? So hence it is known as a possible obligation. Possible, but not probable, right? So if it is possible, then you have to disclose the contingent liability. You have to disclose the contingent liability. Okay. What is meant by remote? If there is a less than 5% chances of outflow, in that case, it will be considered as remote. And in that case, neither the disclosure is required nor provision is required, right? So this is something which is the meaning of probable, possible, and probable, possible, and virtually certain, right? Possible obligation. Now, what is meant by possible obligation? You have understood. If it is less than 50%, it will be considered as a possible obligation. Okay, guys. For example, if the outflow is not probable, means outflow is possible. Outflow is possible, right? So it is not probable, but it is possible. What could be the possible obligation? For example, the company has filed an income tax return, right? The company has filed an income tax return, and the assessing officer has disallowed some expenses. The assessing officer has disallowed some expenses, and the assessing officer has raised a demand note, has raised a notice of demand. The company is saying that, and even in the previous year, even in the previous year, the CIT commissioner has already allowed those expenses, right? So the company is litigating. The company is litigating in the appeal. Okay. So as of now, the company knows that this outflow is not probable, right? But there could be a possible obligation because the demand has come, and there could be a possible obligation that the entity will end up paying, and the entity will end up paying some amount, right? And hence there is a possible obligation where the liability will confirm in the future. The liability will confirm upon happening or non-happening of some future event. Okay. So in this case, it is not a present obligation, it is a possible obligation. Sir, when it will be a present obligation? For example, intentionally the company has disallowed the company has allowed some expenses which the company is aware that yes, the company is aware, yes, these expenses should not form part of your income tax calculation and it has to be disallowed, but the company has allowed these expenses and suppressed the income tax liability and filed the return. So when the case comes and the assessing officer has also disallowed, of course in this case it is a present obligation, right? Liability is also having a present obligation, guys. Okay, it will become your present obligation. But what is a possible obligation? Possible obligation means the obligation will confirm upon happening or non-happening of some future event, right? Upon happening or non-happening of some. Guys, do you remember? I have told you, we have taken an example of the delivery schedule that on 31st March 2016, the company was aware that the company will not be able to deliver by 30th June 2017, right? So in that case, the present obligation was not there, right? The present obligation was not there, but the possible obligation could be there, right? And the possible obligation could be there in future, right? In future, and hence that situation can be shown as a contingent liability, that we will be having this liability in future. So boss, when you are recognizing a provision, you are recognizing in the current period, but when you are disclosing a contingent liability, it does not mean that the liability will not happen. If in the court of law, if in the GST authority, in the income tax department, you will lose the case, you have to pay the penalty or interest or the demand, right? So every contingent liability does not mean that liability will not arise. The liability will arise in future, right? And hence there is a possible obligation which will arise in future, okay, which is depending on the future outcome. Have you understood, guys? Have you understood this? Smith, Jay, Viraj, Kochiki, have you understood this? Let me show you this contingent liability. Let me show you this contingent liability in the annual report, right? Please let me know if the annual report is visible. Please let me know if you are able to see this annual report. Yes, you can see that contingent liability. The company has shown the contingent liability, sales tax, right? Sales tax, stamp duty, entry tax, municipal tax, income tax matter, other claims. See, the company has given the amount, means amount is measurable, right? But these are the possible obligation, or either outflow is not probable, or there is a possible obligation where it will confirm upon happening or non-happening of some future event. It will confirm in the future, right? And hence the company has shown this as a contingent liability, right? So either the outflow is not probable or it is a possible obligation. Okay? Unless otherwise stated below, the management based on legal advice believes that the outcome of these contingency will be favorable and loss is not probable, right? And that is why they have shown it as a contingent liability, right? I've shown you the practically this contingent liability, right, friend? Let me know if you have any doubt. In that example, delivery schedule, can we say that it is arising out of past event? So basically, Koshiki, the contract is there, right? And contract could be one of the trigger of past event. Why I am saying it is not a present obligation. It is a possible obligation which may arise in future, right? And that is why you are showing the contingent liability. Oh, see, all this contingent liability, it does not arise in the current period only. When you got the income tax demand, are you creating a provision immediately? Are you creating a provision immediately? No. Why? Because first you will file the case in the next level, right? Then you will also litigate the case. You will file the case, right, on the merits. So basically, the possible obligation may be arising out of the past event. Why you got the income tax demand? Because you have filed the income tax return. Okay. Or even you have not filed the income tax return, then you got the income tax demand. Right? So what is the past event? Not filing, non-filing of income tax return. What is the past event? Filing of income tax return. Right? We discussed contingent liability, possible obligation, present obligation thing, right? And let's discuss contingent asset. What is meant by contingent asset? First of all, there is a difference between asset and contingent asset. When I'm talking about contingent asset, I'm only talking about disclosure. Something which is contingent is going to be disclosed. But if it become 95% certain, means virtually certain, then asset will be recognized. For example, what is a contingent asset? Possible asset arising from past event to be confirmed by future events not wholly within the control of the entity. Right? For example, there is a company and the company has filed a case against its vendor, right, for a compensation. So guys, the company has filed a case. The company has filed a case of 50 lakh rupees, right, for one of its vendor for claiming a compensation of 50 lakh rupees. So when the company has filed a case, it is a possible asset that the company will get the reimbursement. But the company is not virtually certain, right, that it will get the reimbursement. If the company will have a probability that yes, I will get the reimbursement, only then the company will create an asset, right? For example, when the development of the case will tell the company, we are having more than 50% chances that we will get this money, right? So in that case, you can say that there is a probability that we will get the money. So this contingent asset is required to be disclosed. But if the court announced the verdict and the court announced the compensation in favor of the company, in that case, there will be not probability. There is a virtually certain or certainty will be there. In that case, asset will be recognized. That compensation receivable will be recognized, right? It will no more be a contingent asset. What is the contingent asset? If the chances are remote, that there are less than 5% chances that the entity will get the money, so no disclosure is required. If the chances are not probable, means there are 50% chances, that less than 50% chances or up to 50% chances that the company will get the money, no disclosure is required. But if there are more than 50% chances, up to 95%, but more than 50% chances that the company may get the money, in that case, disclosure is required. But if there are more than 95% chances, it means it is virtually certain. In that case, it is no more a contingent asset. It will become your asset. Then in that case, recognition will be required. I hope it is clear to all of you, friends. Smith is asking how to decide probability. Smith, again, it is something which is depending on the judgment. Again, it is something which require the professional and expert advice, right? Again, this is something which requires the expert's advice, right? For example, in the court cases, your counsel will say, your legal advocates, lawyers will say, right? And as per the development of the case, as per the merit of the case, they will tell you that whether more than 50% chances are there or more than not 50% chances are there. So normally it varies in the ranges. Okay. It is not like we are having 45% chances of winning, 55%. It is not like that. They will say that we are having a very strong case. And that is why we are hopeful and we are confident that we will win the case due to the merits on the ground, right? So these probability will be judged, will be estimated by the professionals, valuers, and experts. right? And even as per the management. For example, in the case of remote example. So every year, let's take an example of income tax, right? So in income tax, there is kind of a, I would say, target also. Like every assessing officer has to meet a target of collection of, let's say, 50 crore. I'm just taking an example. So the company has filed a return, and and every expense was allowed in a particular year. In the next year, the target was increased, and the AO has allowed AO has disallowed certain expenses. The CA was saying, boss, sir, you already have allowed these expenses in the past. Why you are disallowing in the current period? The law has not been changed. But the AO is saying, no, 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 this is not acceptable. I am disallowing this. Go to the CIT appeal and get it allowed. Because he knows it will take at least 1 year, 2 year, 3 years. It will take some time, right? He is aware it will take some time. So the assessing officer is saying, I will disallow, go to the next level and get it cleared. And we are aware that there is less than 5% chances that we will be able to pay, we will be obligated to pay this money. So it means the chances are remote. It means even this liability should not be disclosed as a contingent liability, right? I am claiming something from my vendor just by chance, by luck, that if the time will be in my favor, probably I'll get the money, right? And I know that this claim is frivolous, right? This claim is not right. There is no default on the part of the vendor. And I know that certainly I'll lose the case. It means there is a remote chances that I'll get the money. There is a remote chances. Hardly there is less than 5% chances that the things will be in my favor. So of course, in this case, even this asset will not be disclosed. There is no contingent asset which require disclosure, right? Is it clear? There is no clear guidance regarding that. It depends on the situation. It depends on the experts' experience from this particular matter, or it depends on their judgment. Viraj has asked a very good question as a student. Sir, certainty of percentage of probability will be available in paper or calculation is part of answer? No, this certainty will be, this percentage will be available in the paper, right? Either they will signify you, for example, they will write this thing, the example which I have taken. In the past, this expense was always allowed, right? And just to meet the target, the authority has disallowed these expenses and asked the SSC to get it cleared or get it allowed on the next level. So you should understand that there is a less chances, even there is less than 5% chances that this liability will not happen. So in that case, you will write that going by the past precedent, it is not likely that this liability will come, and hence the chances are remote, which is probably less than 5%, and hence neither disclosure as a contingent liability is required nor a provision is required. Right, Viraj? Have you got how to answer this question? Is it clear? Or you can say that in the question it is written that there are high chances that the company may end up paying this liability. So in that case, you can consider that high chances means probable is there, probability is there, right? Is it clear? Sumit, is it clear? Amit, is it clear? Let's discuss a case study on contingent asset. An entity has filed a legal case on its supplier for liquidated damage of 3 million, 30 lakh rupees. Yeah. The supplier has disagreed with the claim. The supplier has denied and is unwilling to make settlement outside the court. The supplier is also saying, I'll not pay you any money. Let's take it to the court of law. Right? In this case, an inflow of economic benefit is not probable. Right? It is not probable. So in this case, if it is not probable, then in that case, disclosure is not required. Subsequently, the court ruled a judgment in favor of the entity. However, the supplier has filed an appeal against the court order. The lower court has allowed in the favor of the entity, but the supplier went to the higher authority, right, against this order. Management of the entity is of the opinion that again the court order will be in its favor. In this case, it will be appropriate to disclose this amount as contingent asset as the inflow of economic benefit is probable. Right? Recognition of the asset in the books will be appropriate when the final decision in the favor of the entity is received and there is a virtual certainty of inflow of economic benefits. There is a virtual certainty of the inflow of economic benefits. Is it clear? Is it clear, Kuchiki? Whether this case study is clear or is it not clear? Tell me. Is it clear or not clear? Yes? Great. So in the first para, it was not probable and hence even disclosure was not required. In the second para, it is probable and hence disclosure is required. In the third para, if it become virtually certain, then it is not a disclosure, it is not a contingent asset, it will become your absolute asset. Right? Very good. Now, how to measure the provision? The provisions are required to be measured on the basis of the best estimate. Present value we have discussed. Guys, have we discussed the present value concept? Have we discussed the present value concept? Yeah. Let's discuss the present value concept in one case study in this slide also. We have already discussed present value concept in the measurement of a provision, where the effect of the time value of money is material. The amount of a provision shall be the present value of the expenditure expected to require to be settled the obligation. In case of ARO, you remember. So what is the amount we have estimated to settle the obligation after 50 years? So we have calculated the present value of that. In the case of legal claim, the amount which is expected to be paid, which is 20 lakh rupees, we have again discounted to the present value for creating the provision, right? And the discount rate should be the pre-tax rate, right? Which is reflecting the current market assessment of the time value of the money and risk specific to the liability, means which is interest rate generally, weighted average cost of capital or interest rate specific to the borrowing of the entity, right? So the company has estimated that settlement of a legal obligation will give rise to a gross cash outflow of 10 lakh rupees in 3 years time. The company has estimated, see, there was a legal case going on and the company knows that outflow is probable. But the company knows that this legal obligation will give rise to a gross cash outflow. It is also measurable, but it is the settlement will happen after 3 years time. And there is a rate of interest, which is 6%. Calculate the amount of provision to be provided. So how much provision needs to be provided? Guys, what is the present value of the provision? What is the present value of the provision? The present value of the provision is, let's go to the Excel file, case study. What is the present value of provision? It is the, what is the future value? Future cash outflow. Future cash outflow is 10 lakh rupees. 1, 2, 3, 4, 5. 10 lakh rupees. Right. What is the discount rate? Discount rate is 6%. What is the time? Time is 3 years. What is the present value? Present value is 10 lakh divided by 1 plus 6% to the power 3 to the power year. 839,620. 839,619. This is the present value of the compensation. What is the accounting entry? Accounting entry will be provision for compensation. Compensation. Expense debit. To provision. Compensation payable. Accounting entry 89619. Right? What will happen at the end of year? So this is year 1. Now at the end of year 1, End of year one. What is the accounting entry at the end of year one? So now this provision is going to be unwinded, right? This discount is going to be unwinded. 1, 2, 3. What is the opening value? It is 839619. What is the interest rate? This multiply by 6%. Right? What is the closing value? This plus this. Now this will become your opening value. This will become your interest. This is your total value. Now this become your opening value, interest, and closing will be 10 lakh rupees, right? This is how this calculation has to happen. And what is the accounting entry every year? What is the accounting entry? The accounting entry is same. Interest cost account debit, debit to provision for compensation payable. At the end of year one, it is 50,377, right? At the end of year two, this accounting entry will be year two. This will be your 53,400, right? At the end of year three, this will be 56,604, right? And then end of the year three, this liability will be payable, which becomes 10 lakh now. So provision for compensation payable account debit to cash account, which is 10 lakh rupees, right? So this is how this accounting has to happen, right? This is how this accounting has to happen. Case study from PPT, Is it clear? Is it clear, friend? Yes, no, not applicable. So friends, for today's session, I'll keep it till this time only, till this stage only. So this present value part, time value of money part, we have already discussed, right? So the net present value is 839620. The provision of this should be recognized in the balance sheet, and there will be unwinding of the discount at the end of year 1, 2, 3. At the end of third year, provision will reach the obligation amount of INR 10 lakh rupees, right? We have covered this part of present value. Provision has to be recognized on the basis of best estimate, and how to calculate the best estimate, we will be discussing in the next session. So in the next session, we will be discussing the measurement part. We will be discussing the onerous contract. So measurement part, onerous contract, restructuring provision, and one or two specific event, right? So this we will be cover in the next class, right? So let me know if you have any query, any question so far. Otherwise, I'll conclude this session for the day. Do you have any query so far? I hope you have enjoyed the session. I hope you have understood the session very well. You have understood the meaning of liability. Liability is a present obligation arising out of past event where it is expected to have an outflow of resources. What is a provision? It is a liability of uncertain timing or amount, right? When a provision is going to be recognized, when there is a present obligation out of past event where outflow is probable and outflow is measurable, right? Is it clear? If there is a present obligation arising out of past event, but either outflow is not probable or outflow is not measurable, then it will be disclosed as a contingent liability. Or what is a contingent liability? It is a possible obligation where the outcome will be depending upon the happening or non-happening of some future event. What is a contingent asset? The possible asset, again, where the outcome will be depending on the happening or non-happening of some future event. We understood what is meant by remote. Remote means less than 5% probability. What is meant by possible but not probable means up to 50% or 50-50. What is meant by probable means more than 50%. What is meant by virtually certain means more than 95%. Generally, virtually certain is a case where the liability and the asset will become certain, right? Is it clear? So we have understood if the time value of money is material means the provision is going to be settled. I have used the word settled. If the provision is going to be settled after 1 year, then discounting is going to be required. It has to be discounted. And we have also seen 2-3 case study around this discounting part. Thank you so much, guys. Thank you so much for the day. And we'll meet on Tuesday to conclude this standard. Till the time, be happy, stay safe, stay healthy. Bye bye. Take care.
Recording stopped.